Absolutely. And in fact, I'm very keen to find out what HDFC Bank puts out, because that's going to set the tone. I'm going to get the bad results out of the way first, and there's one. So out of the three stocks that I've selected, Dalmia Bharat is a bit of a disappointment. The volumes proving to be the sore spot here. The revenue declined as much as 12%, but the big hit is going to be on the margins front, where you had a contraction to the extent of 16.1% versus 21.6%. The net profit as a result declining as much as 75%. There is a note that has come through. Jefferies has maintained a buy with target price of 2,070. It said that the miss was on account of weak volumes and higher costs for the company, and realizations were slightly better than expected, and unit EBITDA has also improved. But watch out for this one at the start, the earnings not too strong. KEI Industries also a set of not too good results. The revenue came in at 2,467 crore rupees. That was in line, but the margins and the net profit were below. Margins have come in at 9.6%. The net profit coming in higher by about 9.4% at 165 crore rupees. UBS has maintained a buy with a cut of its target price to 5,750 crore rupees from 6,050 crore, 5,750 rupees versus 6,050 rupees earlier. It has in fact said exactly what I just said, in that margins have missed, led by volatile commodities and muted government capex. The last stock that I will talk about is PNB Housing Finance, and this is a thumbs up, a good set of numbers from this housing finance company. The net profit is up as much as 36% at 471 crore rupees. There was some recovery that the lender managed to do from its retail book to the extent of a little over 50 crore rupees. The net interest income growth is as much as 17% and 4% sequentially. The gross NPA has declined 54 basis points to 1.19%, and that's certainly positive. The net interest margin has managed to stay at about 3.7%, and it's actually an improvement sequentially from 3.68%, and the return on assets is also positive at 2.5%. So MS, which is Morgan Stanley, has maintained an overweight with a target price of 1,520.
Okay, so PNB Housing is one glimmer of hope
Yes.
that you're seeing. I wish I could say the same about my list. Unfortunately not.
They're all thumbs down.
No, they're pretty much all thumbs down this morning. That's right. ICICI Pro, thumbs down. You know, because numbers were in line with estimates, fair enough, but margins this quarter have declined because they're simply selling more ULIPs, and that has impacted their margins. ULIPs and group funds share has gone up in their new business, so that's why the value of new business, or VNB margins, a metric which you've seen for insurance companies, has gone down sequentially, quarter on quarter. They're moving to demand as well. And I wonder, the whole case for insurance companies has been that while equities is looking so volatile, maybe some of the family savings which had gone into equity will come back into insurance products or insurance/investment products. Not a great thing for investors, but yes, for those companies, definitely. So let's just look at some of those metrics. Net premium income up 23% at 12,261 crores versus 9,929 crores. Net profit up 43% at 325 crores versus 227 crores. So like I said, the numbers on the face of it look good, but I just want to pull up that graph which tells us about APE and value of new business, because that gives you a greater picture. Solvency ratio was fine, 211% versus 188%. There was a 13-month persistency at 85.8% versus 86.4%. But when you look at the actual VNB number, that seems to have gotten a little slow. So you actually saw that drop a fair bit to 23.2% in this quarter, drop of nearly 2% sequentially. What is Goldman Sachs saying? They've maintained a neutral with a target price of 650 rupees. They're saying the Q3 is in line. APE growth so annualized premium growth basically was driven by ULIPs. Strong growth has come at the cost of margins. Margins decline on mix shifting to lower margin ULIPs and other group funds kind of business. Meanwhile, Macquarie has maintained a neutral with a target price of 725. VNB growth, that's value of new business growth, continues to disappoint in their view. Higher ULIP, declining savings and higher costs have affected margins. They see a downside risk to FY25 value of new business estimates as well. So That's the picture as far as ICICI Pro is concerned. Tata Tech, and we're going to be speaking with the management, I think, in a short while from now. Tata Tech is a thumbs down as well, unfortunately. Revenues are a miss. Margins are largely in line with estimates. And near-term challenges continue due to delayed decision-making in the US. Maybe that changes now, and that is one thing to watch out for. Revenues are up 1.6% this quarter for Tata Tech at 1317 crores. The EBIT was down 1% at 204 crores, marginally. Margins are also down marginally at 15.5% versus 15.8%. Net profit was up 7.1% at 169 crores. If you look at the segments, the service segment was also completely flat. Revenues up 0.8%. They have, though, secured 4 large deals in this quarter. Let me pull up for you what Citi is saying on them. They've maintained a sell with a target price of 765, and in Citi's view, the revenue miss is an issue. The near-term challenges due to delay in decision-making in US is what they talk about, and they say these near-term concerns will likely weigh on growth. But I must come to India Mart as well. Thumbs down, and this is interesting because the numbers on the face of it look good. Revenues are up 16% at 354 crores. EBITDA up 61.4% at 138 crores. Margins at 39, huge jump in margins, 39% versus 28.1%. Net profit up 47%. So the numbers optically look good. Why am I saying it's a thumbs down? Because this Nomura note is interesting. They have downgraded the stock to reduce with a target of 1900 rupees, and not because of just valuations or something like that. And it's a steep cut in target price compared to where the stock is right now. They've said there's an unexpected decline in paying subscriber base, a low gross addition with sticky high customer churn will weigh on collections growth. They say weak gross customer addition with elevated churn is concerning. They've in fact gone ahead and cut the FY25 to 27 profit estimates by, get this, 4 to 13%. So a massive range there, which is why just, the optically positive numbers won't do.
I don't know when the last time, I mean, it might have happened recently for all you know, but 1,900 is the target price down from 3,150. What a massive cut in target price. Of course, that reflects what you just said on the PAT estimates. But clearly something to watch out for in trade today.